All right, so I had a couple of questions. Good afternoon. Had a couple of questions about the exam. The grades should be posted by tomorrow, so you'll get them back probably on Tuesday. You're only going to get your Scantron back on Wednesday during free period. I'll be in this room and I'll go over the exam with you. So if you want to look at question by question, I'll have the exam up on the screen and we'll go over the exam. So we can't give the exams back, but we'll give you the Scantron and then I'll go over it. Okay? So check that tomorrow. Remember, the exam is 20% of your grade. There's another, I guess, a second midterm, if you like, or another exam. That's going to be coming up on the 7th of November. It was originally scheduled for Tuesday, the 5th. It's going to be on the Friday. We're going to move it in on the Friday because there's no class before us, and it's probably going to be easier to get everybody settled in. Okay, so we're starting off with a question, and just want to review where we were last Friday. So the first question is balance sheet classifications. Again, you should know this because it was part of the exam. So I want to know if assets on the balance sheet would be classified as current or non-current if you had them used or consumed within 1 year. Okay, that's been up there for a while, so you should have been able to answer it. And the timer's not coming down, but I'm doing it. I got a time. I got another 5 seconds. I'm doing the timing. For some reason, it's not coming down here. Two, one. Okay. All right. All right, that's interesting because, again, thinking about some of the nuances. By the way, last Friday I was trying to give you a couple of hints on the exams, and since I didn't have the TAs here, it was a pretty noisy class. And if you would have listened a little bit, you would have picked up a few things. And I see you missed something important here because it says current if it's in 1 year, but what has to be true? It's got to be 1 year or operating cycle, whichever is longer. So 1 year is not going to do it. So 1 year is definitely not going to do it. So the answer is going to be false in this case. Now, hold it down. What you have to remember is, again, on these types of questions, now again, it's multiple choice for the exam, and I'm not worried only about the exam, I'm worried about your understanding of the material. So if you think about the question, read it carefully, and what the purpose of the clickers is not only to give you, you loosen up and we'll be having a little fun, but the purpose is for me to see where you're missing something, and obviously if half the class got that wrong, you're missing the operating cycle concept. So let me go over that again. What do we say about an operating cycle? And we're going to see it in Chapter 5 with merchandise inventory. An operating cycle is the cash-to-cash cycle of the company. So you start a business, so let's put this up on the doc cam. All right, so you start your business with cash. I'm going to focus that a little bit. Okay, you use the cash to buy inventory. You might have accounts payable. You have sales. Generates accounts receivable, and it's back to cash again. What you do with the cash, of course, the first thing you do is you pay off your creditors. That's the first thing you need to do, is to pay off the liability. So just think about opening a business. how would you start a business? You'd start a business by putting some cash in, by having accounts payable, setting up lines of credit, and then you buy the inventory. Inventory is sold, generates the receivables, and then we collect them. The first thing you do is you pay off your accounts payable. If you have any excess cash, you might put it into investments. And the third thing you do is you put the cash back in the cycle. And then, of course, if you need the cash, you could always sell the investments and put the cash back in the cycle as well. So when we did this, I asked the question, what types of companies have operating cycles greater than 1 year? I mean, you would think that you would be churning cash constantly and inventory would be moving constantly. And if you remember, I said companies like tobacco companies or alcohol distilling takes more than 1 year for that cycle to complete. So the cycle could take more than 1 year and the asset could still be current. So inventory could be a current asset even if you're not going to use it within the 1 year period. Now, again, you have to think about different business structures or different types of businesses. All right, so that is the first question. And again, just to be sure, any questions on the operating cycle? We're going to come back to that cycle. In fact, in Chapter 5, we're going to come back to the cycle because in Chapter 5, we start talking about merchandise inventory. We'll talk about a retail kind of type of company where inventory becomes a significant asset and a significant investment. And remember what I said, this is not only from a debit and credit standpoint or an accounting standpoint. If you have any interest in business, and I assume you do if you're in the business school, you have to think about managing a company. And just think for a moment, if that inventory is not saleable, you're stuck with cash invested in merchandise that you cannot sell, or if you cannot collect those receivables. And these are the types of issues that we're going to be talking about more from a business perspective, well, not only from a business perspective and accounting perspective, but thinking about cash flow and from a management perspective as well. Okay, any other questions on that one? Now the next one is just the same, it's the same version of this question, and the answer, of course, it says, that's the, and by the way, if you did, I did write, you know, if you look at the course outline, make sure you see the expectations. I've hoped you would have seen this already, so maybe some of you would have seen, let me get this up, seen these questions already. So the next question says, assets that are expected to be converted into cash, sold, or consumed within 1 year, or operating cycle, whichever is longer, of course, is current asset, it's date. I'm not going to ask you that question because I just gave you the explanation before. Okay. So it's date. Okay. Let's do one more, at least. All right, so now, in this case, and I'm doing the timing, so I'll let you know when time's up. Patents, copyrights, and trademarks are examples of what type of asset? What would be the classification? Now remember, we talked about classified balance sheets. Classified balance sheet classifications. Yes. Clicker's not working? Oh. Okay. All right, you got about 5 seconds here. Timing out. All right, so everyone got that one right, almost. So the answer is intangible. So D, these are intangible assets. By definition, they're assets without physical substance, but they have value because of the rights that they confer on the holder. Okay. All right, now, when you look at, I want to go over these next couple with you as well. This next one, of course, the most liquid asset, you really should know that's cash. All right, so the answer here is D. The next one, we talked about the different formats of the balance sheet. So a balance sheet that lists assets and liabilities above, liabilities and stockholders' equity is called the report form. So this is the report form. What does an account form look like? An account form looks like, yeah, like a T account. So the account form looks like a T account. Assets are going to be on the left side, liabilities and equity on the right side. Okay. All right. So last question here, by the way, it would just ask you for, and then this is a perfect exam question. You know, where you're looking at unearned revenue is the amount of cash received and rendered and so on. They tell you what it is, and we want to know, just to let you know, unearned revenue, of course, is a current liability. But what we want to know here is what are the total current liabilities. How would you get that? Add them all up and subtract the non-current. So the only non-current asset you have there is the long-term note payable. So if you add all those up, you'd find out that it would total $37.9, and if you subtract out the current or the long-term liability, it would be C, $12.9. So make sure you can do a problem like this, and these are the types of computations. That's why you don't have calculators. Type of calculations you have in the exam. Okay, so just take the total, subtract out the long term of $25,000, and you would have the amount of the current liabilities. All those liabilities are current except for the note payable. All liabilities here are current except for the note payable. Okay, now let's go to next. Next step in the process, and this is the last real bookkeeping section. We have, or these next few modules, or the last few bookkeeping sections that we have to worry about. Then we start getting into more, like as I said, inventory and receivables. We're going to look at a worksheet. A worksheet is an internal document that is used to help prepare financial statements. It is not a ledger, it is not a journal, it is simply a device. It's like an Excel spreadsheet that you use to help prepare financial statements. You're going to wind up looking at this as really a mechanism that will help you get information that you need to prepare adjusting entries and to prepare the financial statements. It is not a financial statement itself, and it is not considered to be a ledger. Whatever you do on the worksheet has to be eventually journalized, posted, and then put onto the financials. Now, when you look at the worksheet on the format, that's the basic format. It is optional, and it starts, of course, with account titles. Then it has the trial balance, and that first trial balance you see there is the unadjusted trial balance. Then you make your adjustments. And I'm going to show you a better example. I have one from the text, but I also included, I think, a better one that we can use to illustrate it. Then the adjustments would lead you to the adjusted trial balance, and then from there, you could prepare the income statement and the balance sheet. So let me see if I can, I know the actual slide itself is not necessarily clear, but it will show you, if you have it in front of you, if you look at the textbook, what happens is that you take the unadjusted trial balance, and then before you make any journal entries or before you post anything, you would put in the numbers for the adjustments and move them into the adjusted trial balance. The benefit is that you see right away if debits equal credits, you understand the nature of the adjustments, and you look at the reasonableness of those adjustments as well. Also, you're able to move accounts into income statement and balance sheet columns. So if you look at the last four columns, the two income statement and two balance sheet columns, you'll notice that, and I'll put this up on the doc cam in a second, you'll notice that in the income statement columns, before you account for net income, it does not balance. And in the balance sheet columns, before you account for net income, it does not balance as well. So I wrote on this one, so I hope you can see the numbers a little bit better. Let me just bring this in a little bit. Okay, there we go. Because I know some people asked or told me they were having trouble seeing this. So that after you move the adjustments through, and by the way, let me go back to this, because when you're looking at some of these items, for instance, if you took a look at, let's say, the office supplies and the office supplies were 500 and we used up 400, you would actually post this through or enter it in the worksheet, and then the adjusted trial balance would have a balance of 100. So and I'll show you this with a simple example in a second, but you move forward from left to right where you would have the opening balance of 500, someone tells you they used up 400 of supplies, or they told you 100 was left, so you know you have to credit the supplies. And then in fact, you have to debit supplies expense in the income statement columns. And we'll show you that with a simple example. But the key point right now is that all the other columns balance, except that when you look at the income statement, you notice that the credits exceed the debits. And what that tells you is that you have a net income. And on the balance sheet side, you've got debits exceeding credits. The reason why the balance sheet doesn't balance is because you have not transferred or closed out net income to retained earnings. So you have not transferred or closed out the net income to retained earnings. So when you look at these worksheets, you'll see that the closing process, or the net income, is the difference between the 17.5 revenues and the 89.50 of the expenses. That's the 85.50, and that debit will essentially be moved over to the credit side of the balance sheet. And that represents the change in retained earnings due to net income for the period. So when you build a worksheet, it's a device to help you prepare financial statements and to prepare the adjusting entries. Now, I will give you a simple example in just a second. But again, the worksheet is designed to help you prepare financial statements. It helps you prepare the adjusting entries. Obviously, you could test it out. You could see if they are reasonable. Yep. Right, because you're zero. Yeah, what you're doing is you're actually making a closing entry in a sense. So we'll talk about closing entries because all revenues and expenses have to go to zero eventually. So what you're doing is by balancing the worksheet, it's essentially moving, and this is not a journal entry anywhere, it's only on an Excel spreadsheet. All you're doing is you're moving the net income off of the income statement, closing it out, because those are temporary accounts. We mentioned this last Friday. We talked about what are permanent and what are temporary. The income statement accounts are temporary. Those get closed out, and the permanent account, retained earnings, is what we need to think about as going forward, period after period. So you're essentially moving the net income into the retained earnings by having that entry on the worksheet. Now again, it's not an actual worksheet, or not an actual entry, it's a worksheet entry. And you'll hear a lot about worksheet entries if you're in systems analysis or practice in accounting, because worksheet entries don't get booked. They're just put in to assess the effects of certain transactions. Now, obviously you need an example to see this, and we'll do that in just a second. So, let me move to that illustration. If you take a look at, I guess it's slide 49, and I'm going to put this on the doc cam for you so we can work it through. So go to this illustration, and we're going to keep the illustration as simple as possible. And all these numbers are given. So someone gives you a trial balance. Now, of course, this is the unadjusted trial balance. Debits will equal credits, and that's the first step in preparing the trial balance, preparing the financial statements. And again, on the bottom, they should just come in a little bit more. And it tells you that this information comes directly from the ledger accounts. So these are the accounts that you had during the period. You had all the transactions, all of the debits and credits. The journal entries were then posted to the T accounts. Those are the balances. So you have cash of 15, receivables 5, prepaid insurance of 4, the office equipment of 20, and of course there's no accumulated depreciation there yet because you haven't depreciated it. Accounts payable 4, common stock is 10. You've got dividends of, I guess that should be 2. I'll get to that in a second. And then we've got travel revenues of 26. You've got depreciation expense of 2. You've got rent of 2 and salaries. And it should equal, or will equal, 60 on the debit side and 60 on the credit side. Now again, the dividends are 2. That's, the common stock is 20. Accounts payable is 4. And the common stock should be 10. Dividends should be 2.
Just 2 on the debit side?
Yeah. I'm going to move that up. I'm sorry. I got it. It's got to be, sorry about that. These just fell out of alignment. So depreciation is 4. Sorry about that. Okay. Common stock. And then the dividends are 2. Dividends are 2. Okay. Common stock is 20. Okay. Yeah, just those got out of alignment somehow. Okay. So common stock is 20. Accumulated is 4. Accounts payable is 10, and common stock is 20. So those are your unadjusted trial balance numbers. Okay. So let me just make that correction. Okay. All right. Now, the next step is to prepare the adjustments. And in order to prepare the adjustments, you have to come up with information regarding those adjustments. So it tells you that prepaid insurance expired on March 1st, it's $1. Depreciation expense was 2, and salaries expense incurred at the end of March but not yet paid is 5. What type of adjustment does what type of adjustments are the first 2? The prepaid expense and depreciation. Are they accruals or deferrals? Those are deferrals. And obviously the salary expense is an accrual. When you look up at the trial balance, and this one, by the way, is lined up properly. When you look up at the trial balance, it'll tell you that you've got prepaid insurance of 4. The data told you that insurance used up was 1. So you have to debit insurance expense for $1 and credit the prepaid insurance. So on the worksheet, you do this before you actually make the adjustment. Now, if I asked you for the journal entry, you'd write out, you debit the prepaid insurance and debit the insurance expense rather, and credit the prepaid insurance. But in this case, we're doing it right on the worksheet. The second one was the depreciation. And it said that depreciation expense for the year was 2. What's the adjusting entry that you would make? Now, you're going to do this on the worksheet. So you're going to debit depreciation expense for 2, and you can see up on the screen, you would credit the accumulated. So whatever you would have done in a journal, you do on the worksheet. So you debit depreciation expense, and you credit the accumulated. And finally, you've got salary expense that's accrued. You have to debit salary expense and credit salaries payable. Now you notice 2 things. If you look at our original unadjusted trial balance, let me just cover this up for a second. So you look at your original unadjusted trial balance, you did not have insurance expense and you did not have the salaries payable. So the adjustment process will result in opening up additional accounts. So even if there's 0 balance accounts before you started the adjustment process will create additional accounts. So in this adjustment process, you created the account insurance expense, or you opened it up. It was always on your chart of accounts, and you credit the salaries payable. The other benefit of doing it like this, before you make the entries, you see that the debits equal credits, so at least you have reasonable assurance that those adjusting entries are going to be correct. So any questions on the adjustments? Very simple. Again, I wanted to make it as simple as possible. And again, the numbers are lined up properly here, so you shouldn't have any trouble. All right. Now, the third step is we want to try to reflect those adjustments in the adjusted trial balance. So what you would do is go down each line and try to reflect those adjustments. So cash is unadjusted, it comes across as 15. Accounts receivable was not adjusted, that comes across as 5. And again, these are going into their debit and credit columns. The insurance, it started out at 4, but you were told that 1 was used up in the process, so the adjusted trial balance should reflect 3. Office equipment did not change, and the accumulated depreciation started with a credit balance of 4, and it now has an additional depreciation that's accumulated, and that goes to 6. Accounts payable didn't change, common stock and dividends didn't change as well. Travel insurance revenue is 26. Depreciation expense started with 2. You depreciated additional 2, and now it's at 4. Rent expense comes across at 2, and salary expense started at 10, and you accrued an additional 5, and that would be 15. And then insurance expense had nothing at the beginning of the year, was adjusted for $1, and there's $1 in the debit column of the trial balance, and salaries payable did not exist, and as a result got opened up in the adjustment process, and that is now extended. So by moving these across the worksheet, now of course you could program these in Excel, a lot of you know how to do this. You would just put formula derivations in there and then just press a button in or click and everything should come across. The key point again is that the adjustments are now reflected in the adjusted trial balance without making any entries, and the debits equal credit. So again, the purpose is to ensure that the adjustments are reasonable and they have an effect, or at least you can review the effect on the financial statements before you actually book them. Any questions on that step? So that would be the next step in building the worksheet. The next thing we need to do is to prepare the columns for the financial statements. And we're going to wind up extending these, let me just bring this over, into their appropriate columns. Now this is where it's important that you know obviously what goes on a balance sheet and what goes on the income statement. And you might get fooled into thinking that everything before revenue is a balance sheet account and everything below that is an income statement, but notice in the adjustment process you opened up an expense and you also opened up a payable account. So you have to make sure that you know the balance sheet accounts. These are the permanent accounts or the cumulative accounts. So cash, receivables, prepaid, office equipment, and the depreciation, along with the accounts payable, common stock, and the dividends, and the salaries payable go on the balance sheet. On the income statement, you got the revenues and, of course, the expenses. Now, once you have them in the balance sheet and income statement columns, you could determine the amount of net income. When you look at the columns themselves and add them up, let's go to the next one. You'll find out that, sorry about that. Let me just focus that, something happened here. Okay. All right, there we go. You'll find out that the revenues or the credits exceed the debits or the expenses by 4. That is your net income. So the difference between the income statement and the balance, the income statement, debit and credit column is 4. Credits exceed the debits by 4, and as a result, you have a net income. You have to be sure at this point that the balance sheet is also off by 4. And this again is one of the purposes of the worksheet. It really helps you with accuracy, or at least to, although the adjusted trial balance does improve the accuracy of debits and credits, assuming that those are correct, the rest of this process could be, with a lot of accounts, it could be very difficult to keep track of all of them. So we're actually, in pretty good shape with the idea that we have a $4 difference on the income statement columns and a $4 difference on the balance sheet columns. So the net income is that difference. And what we do is we will debit or show the debit in the income statement column and the credit in the balance sheet column. This represents the transfer of net income into retained earnings. The balance sheet will not balance unless income is transferred to stockholders' equity into the retained earnings account. So the process would allow you to observe the effects of adjustments on the financial statements before you actually prepare the journal entries. No adjusting entries were made and no adjusting entries were posted. And then, of course, finally, the other benefit of the worksheet is now you can use these columns to prepare the financial statements. So you can easily prepare the financial statements directly from the columns. So I can simply take the revenues and the expenses and come up with the $4 net income for the travel agency. Once again, you know that the first statement you prepare is the income statement. Next is retained earnings. The beginning balance is 0. Net income gets closed, minus the dividends of 2, give you the ending retained earnings, and that's needed for the balance sheet, so that the balance sheet is prepared directly from the worksheet. Now again, no entries have been made. We simply use the worksheet as a tool. So the financial statements can be constructed directly from the worksheet, and it allows you, again, to test the reasonableness of the adjustments and the accuracy of the adjustments. Any questions on using that worksheet? Again, it's a device that you could easily prepare on Excel, and then once you have the numbers, you would be back to a very simple preparation of the financial statements. Yeah, I'll get the questions. Yeah, me.
For retained earnings,
right.
You take the retained earnings and you use that on the balance sheet.
Right.
If retained earnings was 2, how come you ended up? It was 2.
Yes.
So how come you're putting more on the worksheet?
Let's see. Oh. So we're looking for. Because you're, okay, the question is, why was the move to retained earnings 4? Well, because you didn't deduct the dividends. Right? Yeah. So, yeah, the change in retained earnings is net income minus the dividends. It is, net income should be extended through, let's just see that. Yeah, what that's saying is that you debit the income statement column and you extend it to the credit column of the balance sheet. That's the balance sheet, right? All right, any other questions? Okay. Now, let's take a couple of questions. All right, so if you go to slide 58 if you have it, and I'm going to put this up on the screen for you. All right, so which of the following adjusted balances would typically appear in a balance sheet credit column of the worksheet? So what would you typically find in the credit column of a worksheet? So let's go again. I'm keeping track. Okay, get about 10 seconds and we'll. Okay. All right. All right, so of course, it's salaries payable. In the other choices, if you look at the other choices, is rent revenue a credit or debit? Rent revenue, debit or credit? Credit. For what statement? Income statement. Okay. Insurance expense is a debit, and of course, equipment is a debit on the balance sheet. All right. Okay. Okay, are there any other questions on the worksheet? These are pretty short modules. What we're going to do is see a couple of quick modules with some questions, and then we're going to probably move on to chapter 5, maybe just a little bit. All right, so any other questions on this module, on the worksheet? All right, next. I had somebody in the office today talking about or asking about closing entries. When you think about, and again, we said this on last Friday, and that was introduction to where we're going today. We said way back that income statement accounts are considered to be temporary accounts. Dividend accounts are also temporary. And the example I gave in office hours to explain why revenues would be temporary, if you have a part-time job and you have your W-2 form, the W-2 form for 2012 or 2012 stops with your total cumulative earnings for that period. Then your first paycheck in 2013 only included the paycheck for that 1 week or for that 2-week period that you worked. So in order to properly measure revenues and expenses, we have to close them out. They have to be zero when they start the next period. Now, of course, we don't just throw that information away. If we zero them out, we don't just discard that information. That information is moved to retained earnings. So we have to get a process where we transfer revenues and expenses into retained earnings, and that process is known as the closing process. We also close out dividends. Dividends are also considered temporary accounts. If you remember the definitions, when we first looked at the financial statements, I said the income statement was made up of temporary accounts. They were incomplete accounting or completed accounting cycles. Those cycles are finished. They're completed at the end of the year, and the accounts are temporary. They only survive a single accounting period. We also went on to say the balance sheet accounts are permanent. Those permanent accounts are going to carry forward year after year, and the beginning balance of next year is the ending balance of the year before. So if I end this year with $1,000 in accounts receivable, that's my ending balance of 2013. It's also the beginning balance of 2014. So balance sheet accounts carry forward period after period. So the purpose of this module is to make sure we understand the mechanical process. This is the theoretical issue that we just discussed. That you need to understand that the change in wealth, which is revenue, expense, and dividends, gets closed out or transferred to retained earnings. So that's the theoretical side of this. But the mechanical side would be the implementation through the closing entries. So we want to take a look at the closing entries. And again, as I said, we saw this in Chapter 1, and the change in your wealth is going to be revenues, expenses, net income or net loss, and any dividends declared for the period. I also, by way of review, and I just said this, but again, I'm not only reading, yes? Question? Yeah. You're going to have to, yeah, what's the question? Dividends are temporary accounts, revenues are temporary accounts, expenses are temporary accounts. And they have to go into retained earnings. So the question is, what are the temporary accounts? So income statement accounts and dividends are temporary, and as we said, the income statement is made up of completed accounting cycles. And again, just to review, I've already said this, but you have it. And generally, and then again, I'm trying to embellish on what's on these slides, so make sure that you take some notes as well. And again, we did mention that the balance sheet accounts are cumulative, they are permanent accounts, and they carry over period after period. Now, question again is, how do you get the temporary accounts to zero balances? Again, we're going to do this through closing entries. And Closing entries, as I said, is the mechanical or the formal process that we use to transfer revenues and expenses and dividends to retained earnings. Now, by summary, those are the accounts. Again, this is the summary slide. And at the end of each period, whether it's 6 months, whether it's a month, or whether it's a year, those 3 accounts will have to be closed out. Now, these are not the only temporary accounts we have. We're going to have another temporary account in just a minute, which is known as the income summary. Now, the reason why we're going to have this account called income summary is that what we don't want to see happen is have the retained earnings account cluttered with lots of entries. So we use another account called income summary to accumulate the changes, or at least the closing, of those revenue and expense accounts. Dividends are going to be closed out directly to retained earnings. Revenues and expenses are going to go to income summary. Now, you're going to see this in just a minute, but when you think about the closing process, and I think we'll look at all the temporary accounts. So we have revenues, expenses, and dividends. And we have another account which we'll call income summary. These accounts are temporary. And so those are your temporary accounts. The only permanent account you have is retained earnings in this example. I mean, you have others, all your balance sheet accounts are permanent. So the process is actually very simple. And we'll go through another example in a minute as well. And you have a lot of this, you have the same information in the slides, but I think it's better if we put some numbers up here. So let's say you go through the whole period and you've got revenues and you've got maybe hundreds of different expenses. What you don't want to have happen is you don't want all these expenses transferred one by one to retained earnings. That would clutter up this account. So we use the income summary as a way to accumulate the net income. Dividends are closed directly to retained earnings. So let's take an example of a closing process. Let's say during the year you got 600 in revenues, you got 100 of expenses, and you got $50 of dividends. What you would like to do is make those accounts zero to start the next accounting period. So the question then is, how would you zero out revenues? You debit that account. So you're going to close the revenue account with a $500 debit, and you credit that account with a closing entry by crediting income summary. So that's the first closing entry. Then you would close out expenses. And I'll show you, again, we'll go back to that travel agency example in just a second. How would you close out expenses? All expenses have a normal balance of a debit. In order to make those zero, you have to what? Credit them. So in entry B, I'm going to close this account, and I will debit income summary for the closing. So now at this point, yeah, question? Right, you're just actually moving all of the expenses with its normal balance into the income summary account. And you're just transferring the revenues to the credit side, and you're transferring the expenses to the debit side. Now, of course, these accounts, I'll just double underline them. This account is now zero, and that account is zero. So now you're ready to start accumulating revenues and expenses for next year or next period. So now as soon as I have a sale next year, if I have a $5 revenue next year, I could credit the revenue account. And then I know if I look in my ledger, how much did I sell so far this year? I sold 5. You don't want to accumulate it with the 500 because that happened last period. So you try to keep them, again, with the time period assumption. If you remember studying for the test, all those concepts play out with respect to the closing entries. Now, what's the balance of income summary? 400. So you got a $400 balance here, and that actually represents what? That's your net income for the period. Now, as I said, if the income summary account is temporary, it's not going to be around next period. So I don't want to lose this information. So what do I do with it? I transfer it to retained earnings. So closing entry C, well, the next closing entry, will debit the income summary and credit the retained earnings account. So revenues and expenses go to income summary, and income summary goes to retained earnings. Finally, you have dividends. And dividends are distributions of earnings. If you distributed $50 of dividends for this year, those dividends also have to be reflected in retained earnings. So we have to close out dividends, and we close dividends out to retained earnings directly. That's the only account that gets closed out directly. So in closing entry D, I'm going to debit retained earnings, make that account 0. Income summary 0, and now my balance is $350 in retained earnings.
Does income summary have a normal balance?
Yeah, income summary, good question. Does income summary have a normal balance? No. Because what would happen if expenses exceeded revenues? You'd have a net loss. And then it would have a debit balance before we close it. So good question. So the question is, does income summary have a normal balance? The answer is no. Now, the most important point when we look at the retained earnings account, I'll take some other questions in a second. Balance sheet accounts are permanent. So that's going to last period to period. That balance that I see there, the 350, that is my closing balance for 2013. It is also my beginning balance of what? 2014. So those balances will carry over. Balance sheet accounts are cumulative. They are permanent. Sometimes they call them real accounts for some reason, but they carry over period after period. So they're always going to be on the balance sheet. And the ending balance of 2013, so let's just say the ending balance of 2013 is equal to the beginning balance of 2014. And that's a critical piece of information for your understanding with respect to all permanent accounts, not just retained earnings. All permanent accounts operate that way. Right. So I'm going to go through an example with you using that travel agency illustration in just a moment. Of course, in the slides, you've got another illustration just like this without numbers, but I think it's important for you to see the numbers on how this works. Any questions before we take a look at another example, or at least the illustration from the travel agent? And then, of course, just to let you know, on the slides, if you go up That's the closing process that is from the textbook as well. Now, they do give you an example. I'm sorry. Yes? Yes. I'm going to do that right now. Yeah, the question is, how do the closing entries relate to the worksheet? Now, remember, the worksheet allows you to do lots of things. It allows you to look at the effects of the adjustments before you actually make all the journal entries. It allows you to see the effects on the financial statements before these entries are actually recorded. And then it's going to allow you to make the closing entries. So the closing entries also come directly off of the worksheet. Now, rather than use this example from the text, you could always go back to this one. I'm going to try to go back to and I'm going to put this up on the screen for you. I want to use our travel agency example. So I'm going to put this up on the doc cam for you, so I think it's easier to see. And the accounts that we have to close out are going to be the income statement accounts have to be closed, and so do the dividends. So when you look at the closing, you're going to wind up closing out the dividends and all of the income statement accounts. Now again, if you're looking at a worksheet, and again, this could be a multiple choice question. I could give you in the next exam, I could give you a worksheet. And you'd have to go down and pick off the accounts that get closed. Don't forget, even below this total, we had to create, or at least open up, the insurance expense account in the adjustment process. All right, so now let's take a look at I'll put this right here so we can see, and I'll put the entries up on the board in a second, or on the screen in a second. All right, so now, when you look at your revenues and expenses, dividends are 2, revenues are 26, depreciation is 4, rent is 2, salaries are 15, and insurance is 1. The first thing we need to do is to close revenues to income summary. Then we close these expenses to income summary. The net income for the period is 4. That should be the balance of the income summary account. That gets closed to retained earnings, and then we're going to close out the dividends. So let's see how this would work. All right, so the first entry would come directly off the worksheet. So closing entry number 1 would debit the revenue, the travel service revenue or the service revenue, and credit the income summary for 26. We then take the expenses. And in order to close out the expenses, these are credited. So we debit income summary for the total, and we credit depreciation expense to make that account 0. We'll credit rent, salaries, and insurance. Those accounts are now all going to be 0. And the balance in income summary at this point should be 4. And if you look at the worksheet again, this is essentially what the income summary account would look like. So the income summary would have debits of 22, credits of 26, and the balance would be 4. And that balance would have to be then transferred to retained earnings. And we transfer that to retained earnings by entry number 3. So we debit income summary and credit the retained earnings. So at this point, if you draw up the T accounts for each one of these, and you'll see a lot of this in terms of exercises or in homework, you'd find out that the revenues are now 0, all those expenses have 0 balances, and the income summary has a 0 balance. And of course, now you transfer the dividends to retained earnings, you debit retained earnings, and credit the dividends. So after the process of journalizing and posting those closing entries, you now only have permanent accounts. The only accounts that are going to be left are going to be balance sheet accounts. So right now, if I prepared we'll see this in a moment, but if I prepared a post-closing trial balance, meaning that if I went now to my ledger, what accounts am I going to find? Only balance sheet accounts. So that one of the things you have to be aware of, we'll see a little bit of this in the next module. In fact, it's very quick. The next module will tell you that if you go to the ledger after all of the accounts have been closed out, all the temporary accounts have been closed, the only accounts that remain are balance sheet accounts, so that if you're preparing a post-closing trial balance, you should only have balance sheet accounts. And the ending retained earnings should reflect the revenues and expenses and the dividends for that prior period. Okay? All right, so any questions on the use of the closing entries? Okay, again, these are pretty quick as we start to end the bookkeeping or the mechanical part of the chapter. Yeah, Anthony?
Pretty much debiting the total, on the worksheet, you're debiting the total of that income summary account.
Right. Yeah. And the credit, you credit. And then the individual accounts get, you take all the expenses, credit all those, and all the revenues get debited. All right. All right, so let's try some questions. Just a couple. All right, so the first question says the adjusting process zeroes out all revenues and expense accounts. So I'll give you a minute for this one. This is a warm-up. Okay, I'm timing it, so. Okay, about 10 seconds in. Okay. Okay. How can anybody get that one wrong? It says the adjusting process closes out or zeroes out. Can't get that wrong. It's false. The closing process. Okay, it's the closing process. All right, so if you got that one wrong, just make sure you know that the adjusting process doesn't close out the accounts. The adjusting process is designed to reflect the accruals and deferrals that occurred during the period. Okay. The next one is easy. I just wanted to see. Well, at least I know that 27% of the people don't pay attention. It's better than I thought. Okay. All right. Permanent accounts are not closed. Of course, that is true, I would hope. You know that. Okay. All right, so in the closing process, the dividend account is closed to retained earnings, while revenue and expense is closed to income summary. That's also true. Why? You said false? Okay. All right, now, this one I'm going to ask you. Depreciation expense and accumulated are both permanent accounts. Okay. You got about 15 seconds. Okay. All right, so yeah, that's B is correct, because of the fact that depreciation expense is a temporary account accumulated depreciation is a balance sheet account, it's a contra asset account. So the answer, of course, is going to be B. Okay. Now, I'm not going to just remember the post-closing trial balance. Again, this last module, we're not going to spend much time on this, except you need to know that the post-closing trial balance will only contain balance sheet accounts. Will only contain balance sheet accounts since all of the revenues and expenses would have had a zero balance. And on the next slide, which you can just look at briefly, will tell you that if you look at that post-closing trial balance, the only accounts that should be left over and starting the next period is going to be the balance sheet account. So at the end of the closing process, after you do the worksheet, after you have all the entries journalized and posted, you're going to wind up with a post-closing trial balance that ensures not accuracy, but it ensures that debits will equal credits. So you just want to make sure that the adjusting and closing process was as, I guess, efficient as possible.
So you use the adjusted trial balance to find the financial statements, right?
Yes.
So what is the point of the
This is just to make sure that the closing entries were, well, just, you can't say correctly, but you want to make sure that the result of the closing is that debits equal credits. So the question is, what's the purpose of the adjusting or the closing or post-closing trial? Come on, guys, listen. This happened last Friday, and I was trying to give you tips for the exam, and the averages, you know what I mean. So just hold it down. Just make sure. I'm not just reading off PowerPoint slides. I'm trying to add to that. Things I say, if you're not taking notes, you're going to miss a lot of questions even on the next exam. And don't forget, you got a quiz coming up for Tuesday, and you got homework due Sunday. So let's make sure. And if you look at the, if you're not, I don't like to threaten people with percentages, but I guess I have to. So if you look at the percentages, the quizzes are 20%, homework is 15%, clickers are 10, and I'm looking at the number that's at 10%. So I'm looking at the number here. You got 168 people out of a class of 224. Don't know where the other 60 are. So that's one problem. And the other problem is the homework, 15%, and the quizzes are 10%. So even if you got 100 on the quiz, which one person did, even if you did, that's only 20% of your grade. So you got to make sure that you're careful with all of the points that you have. I want to make sure everyone finishes. And personally, I do care if you do well, but if you want to talk and make a lot of noise, it's hard for everyone else to concentrate. So someone told me today in office hours, it's very hard to concentrate with the noise level. So if you can hold it down, it's fine. If you want to, talk, please, a little bit, but you got to do it outside if you want to get really loud. Okay? All right. So again, the question was, which was a good question, why do you have a post-closing trial balance if you already prepared financial statements? If the financial statements are already prepared and all the revenue and expense accounts are closed, why would you prepare the post-closing trial balance? Well, like any other trial balance, the purpose is to ensure the equality of the debits and credits. Doesn't ensure accuracy, but it ensures the equality of the debits and credits. If this didn't balance, you know you have a problem, and it could indicate that your financial statements are wrong. So the design is to ensure the equality of the debits and credits. Okay, now the last thing we're going to do is we're just going to go through the cycle one more time as a review. So, and then we're going to move to chapter 5. So when you look at the cycle, you start the year with beginning account balances. What accounts are those? Balance sheet or income statement? Balance sheet. You close out all the income statement accounts. So you start them off. Only permanent accounts start the cycle. Then you have transactions. So you analyze transactions. We're going to look at invoices and other documents that will be the basis for recording transactions. So we record the transactions. Those are debit and credit entries. Those are the journal entries we make for the current period. Then you post the entries to the ledger. And then you prepare the unadjusted trial balance. The unadjusted trial balance is designed Again, not for accuracy, but just to ensure that debits are equal to credits. Then we said you got the optional worksheet where, again, it's a tool to help you understand the nature of the adjustments and also help you to prepare the financial statements. From the worksheet, you actually make the journal entry. So look at the difference between step 5 and 6. In step 5, you're just entering something on an Excel spreadsheet. On 6, you have to journalize and post them. So you haven't made any journal entries yet, and you have not affected your accounting entry. So a worksheet entry does not get into the accounts. The worksheet entry does not hit the ledger accounts. And then from there, you prepare the adjusted trial balance. Once again, you're trying to be sure that debits equal credits before you prepare the financials. Then you prepare your financial statements, and then closing entries could be journalized and posted. So we just went through the journal entries for the closing entries. Once they're posted, you have the post-closing trial balance that once again ensures that debits equal credits. It does not necessarily prove accuracy, but it just lets you know that debits are, or at least ensures that debits are equal credits. Then number 10, of course, ends the cycle, and then we start the next year with the balance sheet. So that's basically where we've been in the course so far. And in every step of the way, what you have to do is ensure that you understand not only the mechanics, but the, I guess, the nature or the theory behind each one of those steps. All right, so now that's it for chapter 4. So once again, we're going to start 5 in just a second. But in chapter 4, you have the homework that's due Sunday. So someone suggested, which I think was a good idea, have the assignments due every Sunday. So they are. So that's going to be due this Sunday, chapter 4. And then the quiz for this material is going to be due 1 o'clock on Tuesday. And I sent an email just to be sure, because some people didn't seem to understand the difference between quizzes and homework. Quizzes are timed, and I would love to be able to give a quiz here every day. I would give you a quiz once a week or every class, but it's very difficult to manage the paper flow as you saw from the other exam. So the online quizzes are timed for a very important reason. They're exams. So you really have to prepare before you get on. It's probably what you're doing. If you're running out of time, probably what you're doing is you're sitting there with your books, turning it on and then flipping around, then you run out of time, right? So that's not the way to do it. You have to, and in fact, I was telling somebody today during office hours, there is a setting that I could use. I could use a setting that you are not allowed to get onto the quiz unless you finish the homework for the chapter. And that I won't do that, but that's the purpose of that setting, to make sure you're prepared for the quiz. So the quizzes, again, are 10% of the grade. So that'll be due on Tuesday. Now, that'll only include up to chapter 4. Okay? Okay, so now, let's go to 5. Yep. Let me get this. Okay. All right. Yes. Question. Okay. How much? 10. Okay. What's that? Yeah. Half. All right. Now, we're starting chapter 5, by the way. Ending chapter 4 is not in the class. My official timekeeper tells me we have 10 minutes. Okay. All right. So, in chapter 5, we're going to start looking at merchandising operations. And this is where we're going to get involved with issues that relate to inventory, that will now take us from a service organization to a company that will sell products. So in a merchandising operation, we're going to move away from service operations. First, we're just going to describe the merchandising operations. We're not going to do anything on the type of inventory system right now. So anyone that sells goods and services is known as a merchandiser, and obviously we just talked about this before we started the class with respect to the operating cycle of a merchandising company. So we said the importance, if you look at the cycle, we're just taking a piece of that cycle now. The importance of the cycle is the fact that when you carry inventory, you're tying up cash for a period of time that hopefully isn't too long, because you don't want to have money invested in inventory that you cannot sell. Also missing from this cycle, of course, is the fact that you could buy on credit and have trade payables in there. So the cycle is where you take some cash, and hopefully, and I had this drawn up on the doc cam before, you take some cash, you buy inventory or you get credit for the inventory, you sell it, it creates a receivable which you hope you collect, and you get your cash back. Any delay or any problems within these two areas could cause bankruptcy. If you can't sell inventory and if you can't collect the receivables, you're out of business. Yeah. You could sell for cash. Yeah, you could sell for cash. Most businesses today have very few, except it's a very small store or very small operation. Most businesses do not have a lot of cash sales. So 90% of the types of businesses that we look at in large corporations would have your accounts receivable. Yep.
If it's a small business that has like a credit card machine, you use both.
Yep. If you have a credit card machine actually or a debit card machine, it's really cash. It's as good as cash because you get that almost instantly. So we're talking about businesses that might have, businesses that have open accounts. You call up and you want a shipment of, some type of building materials for construction or lighting, and that would come in. You don't use a credit card for that. You have an open account. And you hear a lot of people will tell you, I have an account at this store or that particular, if I'm a contractor, I've got an account at Home Depot. So I walk in Home Depot and I just walk out with the materials and they just charge my account. Okay, I don't use a credit card. Okay, now, a wholesaler versus a retailer, what's the difference? A wholesale company versus a retail company. Yeah. Yeah. All right, yeah, that may be representative. A wholesale company may sell very few products. Yeah, wholesale sells to retail. So a company like, Apple is both, right? They're both. But Apple they sell their products through their own stores, to their retail outlets. They also sell to other companies like Best Buy. You might find Apple products there as well, or Verizon. When they sell to Verizon, they're wholesaling. When they sell their own products, they're retailing. Okay? So a wholesaler will sell products to retailers. Retailers are selling the product to the final customer. And again, the most important thing to think about is the management of accounts receivable, but actually this slide comes from the publisher. You really should add managing accounts receivable and managing inventory. When you talk about supply chain and managing the supply chain, that's where the critical piece comes in, is managing inventory. How much to buy and when to buy it, right? Because if you overbuy, you could be stuck with obsolete items. If you underpurchase, you could miss sales. You could have lost opportunities from not being able to sell to customers. Okay. Now, a couple of things that are going to be different. When we look at a merchandising company, we no longer have service revenue. Their revenues are known as sales. So you'll have either sales revenue or sales, and their expenses now fall into two categories. The reason why we have this first category, cost of goods sold, we now have to account for the cost of merchandise we buy and then resell. We're talking about a retailer now. You buy the inventory, that's the cost of the goods that you're selling. Remember, a service company doesn't have a real cost of goods sold. So if I'm a consultant, or if I'm going out as a management consultant or an information technology consultant, I'll go out there with my own computer and that's it, and I do some work and then leave. I'm providing a service. I don't pay anything up front to have that service provided. But when I sell a product, for example, Apple is going to an Apple retail store, has to pay Apple, or Best Buy has to pay Apple, or whatever computers they're selling, or Verizon pays Apple for the cost of the iPhone. So that cost is the cost of goods sold, and that's on top of other operating expenses. And you're going to find out that cost of goods sold is probably one of the more critical pieces of an income statement. So that when you look at a merchandising company's income statement, it's going to look very, very different from a service company, because it's going to have something known as gross profit. Gross profit on their income statement is going to be the difference between sales and cost of goods sold. So when you look at the income statement now, So you have sales revenue, let's use the number they have there. So you sell a product for $5,000, but that product costs you $3,000. We subtract that to get what is known as the gross profit. So sales less the cost of goods sold is known as the gross profit. The idea is that you buy the product for $3,000 and then you mark it up at a premium. You're trying to, obviously you want to sell it for more than you pay. The gross profit, as I go on to tell you, is probably one of the most important measures in a merchandising operation, because don't forget, you still have to cover your operating expenses. So let's say operating expenses are 500. Now you got net income of 1,005. So the gross profit is one of the more significant measures of income because it allows you to determine if you could cover your operating expenses.